yet. So you should be able to see them popping in.
I see people popping in. Good afternoon and welcome. I am Colleen Kern, a director with Tax Time CPAs. Today we are hosting our final business Espresso, your jolt of business acumen. Our hosts have extensive backgrounds in their respective fields of sales and marketing, accounting, wealth management, and law. Their backgrounds have all come together to help small businesses thrive. Today, we have two experts from our panel, Mike and Christina, informing us about an underutilized business exit strategy. We've enjoyed bringing you these 30-minute presentations every other week, presented by an expert to help you create, build, and optimize your business. Going forward, you can expect a change in our formatting to bring you true jolts of business acumen with shorter 2-minute-ish videos Monday through Friday from our panel to help you make you better at running your business, not being run by your business. Make sure you like and subscribe our YouTube channel to catch tips from all of our experts, and join our Facebook group to be the first to know about all of our new content and connect with like-minded business owners. Before I introduce today's hosts, a little reminder, we do try to make these as interactive as possible. If you have a question, pop them in that chat or in the Q&A box, and we'll try and answer those live. After our presentation, we will open it up to questions from our panel and from the audience. So without further ado, our hosts on our panel today are John Gies, business growth strategist from RAS Squared, our expert in scaling your business in sales and marketing, and myself, I am a director with Tax Time CPAs. Finally, our presenters today is Christina Gilbertson, owner of Gilbertson Law Office. She has extensive experience as a trial lawyer. Christina knows the importance of strong legal documents. Her law firm is focused on helping small businesses protect what they've worked so hard to build. Christina's clients can let go of the uncertainty of cost-prohibitive nature of hourly billing and plan for comprehensive legal services they need billed via subscription and flat fees. Mike Hurdle is the founding member of Tax Time CPAs. He has built his tax strategy firm to meet his clients where they are. No excessive jargon or stuffy business suits here. The firm is built on subscriptions to encourage proactive communication so you don't wait until tax time to ask and get your questions answered. With over 20 years of experience, Mike's knowledge covers everything from corporate to nonprofits, accounting and tax, and his passion is taking his wealth of knowledge and converting it into effective tax strategy for his clients. Mike and Christina, I'm excited for this joint presentation. Take it away.
Hey, thanks, Colleen. All right, so deferred asset sales trust, deferred sales trust. So one of the big things that we want to talk about is how do we save money on taxes? Again, we've talked about it here over the past 3 months, and it's not about necessarily going out and spending more money to get deductions. It's about taking the money that you've already spent and finding ways to get it business tax deductible. Same concept here on the revenue side. So if you have revenue that is coming in, how do I get that to be tax deferred? How do I save money in taxes doing the exact same thing either way? So one of this underutilized strategy is called a deferred sales trust. So what is a deferred sales trust? It's a method that's used to defer capital gains tax when selling real estate or other business assets that are subject to capital gains, right? Instead of receiving all the sale proceeds at closing, the money's put into a trust, and only the taxes from the funds and only the taxes are generated when the funds are actually received by you from the trust. So deferred sales trusts work with Internal Revenue Code 453. Again, that's kind of the Internal Revenue jargon, tax jargon, but that's the tax law that prevents a taxpayer from having to pay taxes on money they haven't received yet. So again, for all the small business owners who are cash basis types of reporters, even if I make a sale, unless the client pays me, I don't have to recognize the tax on that until I actually receive the cash. This is the same concept, and this trust is established to do basically the same kind of concept, the same thing. So how does a deferred asset trust work? So there's 5 basic steps that are involved in this, and we'll do some visual graphics to kind of make it a little bit here, but I just want to go through these real quick so everyone kind of understands them. First of all, a third-party trust has to be formed and will be managed by a third-party trustee. Again, you can't have your brother kind of come in and manage the trust for you. It's got to be a third party. It's got to be family relationships. The real estate, and number 2, the real estate asset is sold, or the business asset is sold to the trust with an installment sales contract. Okay. An installment sales contract is basically saying, hey, I'm going to sell you $1 million worth of stuff. You pay me over 10 years at $100,000 a year. It's just an installment sale. Third step is the trust sells the real estate or the business asset to a buyer and receives the funds from the buyer. 4, the third-party trustee invests the funds or distributes installment payments at the seller's discretion. And then 5, the capital gain taxes are paid on any principal amounts that you receive from your installment payments. So really, what is the difference on that? So here's a kind of a graphical representation, but think of it as if, hey, I'm going to go sell my business today, and I'm going to generate $500,000 from it. Well, if that generates $500,000 capital gains today, and I get that cash today, I complete the transaction, the buyer pays me, I've got $500,000 of capital gains that I have to record in tax in the current year. If I can use an installment sale, I can span that out. I can defer that over the years upon which I receive the cash. The deferred asset sales trust is a way to do that. Now, you could also do that yourself through an installment sale. You know, if you want to seller finance to the buyer and say, hey, I'm going to give you the loan and just pay me over 5 years, pay me over 10 years. What's the big downside to that? Well, if he stops paying you, now you don't have any cash, right? You have to take him to court, and who knows if you'll ever collect on it. Right? We've all had those bad business deals. But with the deferred sales trust, all of the cash comes from the buyer. It just sits in a trust, and you get the benefit of deferring it over time. So what we want to look through here is just the visual graphical. Some people are visual, some people are numbers oriented. So again, step 1, you set up the trust. The investor puts the assets in the trust, and you make the agreement with your trustee of how you're going to be able to get the money back out of the trust. 2, the trustee sells the business to the buyer. Buyer pays the trust. In 3, the trust invests the cash. And again, your assets can sit in this trust and also be invested in stocks, bonds, another business, and can generate cash and grow as well, even before you get the money back. So not only are you deferring capital gains, you're taking the money that you would have had for capital gains taxes that would have given to the government, and you can actually invest that and help it grow even more. And then 5, when you get money back out of the trust, on the principal payments, you pay your capital gains taxes on that. So let's take a real quick look at what that looks like. So there's three different capital gains tax rate of 0, 15%, and 20% based on where you fall. We're just going to say, hey, we sold it for $500,000, so we're going to look at the middle column, right? But if I take the capital gains out and I can slide this through this deferral process to be in that $80,000 per year range under, I can effectively lower my capital gains tax to 0 by deferring it over 10 years rather than taking the one lump sum hit. So again, if we're sitting here in the middle column, 15% tax generates about $75,000 of capital gains taxes you're going to pay to the IRS, and about another 23%. We're doing this in Colorado, so we're going to use Colorado's. So in a $500,000 capital gains sale of your business, all of a sudden $98,000 is going to the government. So you're going to get $401,000 in your pocket. Not bad, but again, let's take a look at what this looks like over time. So if I take that $401,000 and let's just say I'm going to withdraw out of the trust, I put it into a regular brokerage account that is not a trust. So I've got the $400,000, I pay the capital gains, and I'm just going to withdraw it out of my account. I'm going to let it work in the market. I'm going to take out $50,000 over 10 years. Well, this shows the kind of withdrawal from the account and the reduced balance at the end. So at the end of 10 years, you would have withdrawn the $500,000, but you also would have generated some interest on that income that would have been taxable. So you would have generated another $18,000 of taxes. Puts your total taxes for that transaction at about $115,000. What if we used a deferred asset trust, deferred sales trust, to do the deferral? Well, the full $500,000 goes into the trust. Now the trust can invest that money while it's sitting there and then pay out the same 50,000 that we looked at from the other side. So what this shows is, one, I'm taking that capital gains tax that I would have given to the government, and I've got it invested in my own trust, generating income, growing, doing whatever it needs to do. I'm still taking out the $50,000 per year, $500,000. But the big difference here is, if you look at it to the end, my total taxable income is only $26,000 because I slid my taxable income under that $80,000 cap. Now, again, there's a caveat. We're assuming you don't have any other income. It's really more of a tax strategy. But if we can slide it under that 80,000 for annual income, now there's a zero cap gain tax rate. So by deferring and spreading it, I'm only going to pay the tax on the increase that it generates every year, which leads to $26,000. The big takeaway here is we've just saved $89,000 in taxes over these 10 years. And your bank account at the end has $148,000 more in it. So the previous one, you had $1,500 left in it. You pretty much depleted everything. This, after taking the $50,000 out per year, you still have $150,000 left in your account, in your trust account. So with that said, hopefully you can kind of see the power and the impact of deferral. Again, it's compound interest and deferring taxes, and we want to use other people's money to make money. So I'm going to turn it over to Christina.
Thanks, Mike. So yeah, this is a very powerful tool that you might be able to use, but in order to actually take advantage of these, the tax deferral, you have to dot every I, cross every T. Did I say that right? Yeah. And make sure that you're doing everything that you possibly can, because if the IRS decides that they want to audit your trust and they find that it's been a sham trust, is what they call it, then that's going to basically erase all of your potential savings, and you could end up with fines and all that fun stuff. So let me be the downer and say, here's what the stuff that you have to make sure that you're keeping track of. So first of all, you have to create the trust, which would be an irrevocable trust. A lot of people, when they're creating their personal estate plan, they have a revocable trust, but that just means that up until the time that they die, they can make change to that trust. In order for this to qualify as under the IRS code, you have to make sure that it's an irrevocable trust, meaning changes can't be made to it, and it is what it is when you create it. The trust does have to be created before the sale or tax triggering event occurs. So before you sell your business, before you sell the real estate, or whatever it is that you're going to be potentially seeing those capital gains taxes, you need to make sure that your trust is set up ahead of time. The trust has to take actual legal title to the sale proceeds and to the business itself in order for this to work. And those assets have to remain in the trust until things are dispersed according to the trust agreement that is handled by the independent trustee. So that independent trustee is one of the biggest pieces here. Like Mike said, you can't have your brother come in and manage it for you. It should be somebody that you don't have control over. You can't tell them what to do. You can't have influence over them, anything like that. You as the taxpayer or investor, you have to relinquish all ownership and control over the asset to the trust. Again, like Mike said, there could be some risks to that. If you're dealing with a Bernie Madoff type of person, you want to make sure that you're picking the right independent trustee and somebody that knows what they're doing and knows, that they're a fiduciary to you. So they are obligated to act in your best interest. So you just want to be really careful with who you choose to do that for you, because they are going to have absolute complete control over the asset and the distributions. So the other piece of it is, once you transfer the business over to the trust, and then they sell it to somebody on your behalf, which then gives you the installment contract, that asset has to be transferred to a bona fide third party, meaning you can't transfer your asset to the trust and then they sell it to your brother. They can't sell it to a business that you have an ownership in. It has to be a truly independent, bona fide third party that you don't have any relationship or control to or interest in. Otherwise, again, that's going to start getting the attention of the IRS, which none of us ever want to have. And then they'll do their digging, and then that's just going to make your life a mess, and you don't want to deal with that. This is a different type of a trust than what most people are thinking when they're thinking about it as their estate plan for their personal assets. The documents have to be meticulously drafted, making sure that everything is, done to the T. One small mistake in those documents could nullify what you're trying to do here. So you want to make sure that you're dealing with somebody that absolutely knows what those requirements are and knows what hoops have to be jumped through. And then you also have to make sure that your trustee is operating the trust under the guise of the law and making sure that they're doing what they're supposed to do under the tax laws, as well as under the trust agreement that that is set up for the trust itself. So these are big picture things that you need to take care of. And I mentioned the term sham trust. There's a 4-part test that essentially the IRS is going to look at to see, is this trust legitimate? Is this something that really should be getting the deferred taxation benefits? And the first question is the investor's relationship to the property or the asset materially different before and after the trust's creation? Again, that's just saying, did you actually own the asset first and then you transferred it to the trust and now you don't technically own it anymore? You don't have, and your relationship with it is patently different. You don't control it, you don't own it, it's very different. Second question is there an independent trustee? Can't hit you over the head enough with that. You're making sure that it is absolutely independent. Another thing that they look at is there any kind of an economic interest that's passed to other trust beneficiaries? So there should be, there's been instances where the asset or the investor set up the trust to benefit his children. That's okay. As long as it's still where those installment payments go to his children, or they have it set up that if something happens to them, that the payments still keep going to their estate and everything. But you have to make sure that you're setting that up appropriately so that it doesn't look, you don't want to have any red flags or any gray area when it comes to that. And then you have to make sure that you as the investor are respecting the restrictions that are placed on the trust operation as set forth in the trust documents. Again, that you're relinquishing all control, that you're just saying, okay, here, this is yours. And then you're going to sit back and you're going to collect the principal through the installment payments. It seems simple. I know it really does seem simple, but there's a lot of ways that this can go wrong for you. So just making sure that you're doing everything right and you have qualified people that know what they're doing to set this up for you. And then you'll be able to see those fantastic tax benefits that Mike was talking about. So if this is something that you're interested in, make sure you're doing your due diligence, make sure you're making the right decisions and trusting the right people. And just kind of in passing, the term deferred sales trust is a trademarked name. That term doesn't show up anywhere in the IRS code or anything like that. Then there's only certain people that can set up technically a deferred sales trust, but that calls it that. But there are others. Anybody can set up the trust with the right parameters that we've discussed today. It just might have a slightly different name to it. So if you go out there and you do a Google search, then you might see, only these 5 people are qualified to do a deferred sales trust. And yes, those 5 people are qualified to use the name deferred sales trust. That doesn't mean that they're the only ones that can actually do it. So just keep that in mind. There's people like to own the idea and the name of it, but that doesn't mean that they're the only ones that can do it. So hopefully this was helpful. I know it's a really high level, big picture, but it's a great tool to use if you can set it up the right way.
Awesome. We do have a couple questions, and I think one kind of goes back to the sham trust and everything, but can an owner provide input into the investments the trust makes, or will that does that have to be spelled out at the beginning, or would that be something that can be done throughout the life of the trust?
Yeah, I think one of the big things that you want to be able to do is to make sure that there's a 4-part kind of team. You've got your attorney that drafts it, you've got your accountant to file all the taxes. You also want to have a financial advisor and the trustee. So the financial advisor is the one that's really going to kind of guide the trustee on risk tolerance. So when you set it up and set up the installment contract and the trust, you can certainly set it up to say, this is my risk tolerance. These are the things that we want it invested in. You can certainly provide the guidance. You just cannot direct, hey, I want X, Y, and Z right here, right now.
Got it. John, does that answer your question? Awesome. And then we had another question from Alan. Have you considered the legal and trustee costs in your savings calculations?
No, those are not factored in. So those are just purely tax savings. So again, if you're looking at, $89,000 in one of those scenarios, and again, that's also assuming you don't have other income coming in from other stock sales and Social Security and those kinds of things. So again, it's a more grandiose tax planning strategy. But again, I mean, you would have to factor in those tax savings and minus the costs of the trustee, the legal fees, and the accounting fees to file the returns on that.
Which I'm sure vary depending on how large and how much work is done, yada, yada.
Yeah, and again, one of those things that I kind of baked into that was only a 5% return. So it was a conservative value on what the assets are going to be earning. So again, if you take a more aggressive approach, but kind of like Christina said, there's so many possibilities to be creative that you can start to provide for your kids long term, right? If you've got a big enough asset sale, you can set it up with multiple beneficiaries with that trust agreement and really create some long-term wealth and defer. You can defer it out for greater than 10 years. I just use 10 years to make the math easy.
Like those round numbers.
Like the round numbers.
Yeah. If anyone else has any questions, feel free to pop them in the chat or the Q&A box and we'll get them answered for you.
I do have a question. Sometimes trusts can be very restrictive. There are some pitfalls or some things that the owner wants to look out for so that they can optimize the trust and not have restrictions that might harm them down the road. That's probably for Christina.
Yeah. So yes, I mean, you're going to have to figure out what the terms of that trust agreement are going to be, what the terms of those payments are going to be. This is, again, it's going to be in most cases different than your typical trust agreement where you can place restrictions on, like if you split a spendthrift trust, for example, if you have somebody that's terrible with money, they're probably not going to be the investor. Let's start it with that because they're probably not going to have a bunch of money and have made good decisions to be in that position. But in that type of a trust arrangement, yes, you can say that you can only get distributions at certain times and everything there. But what we have different in this case is you have the installment contract, and that's really going to be the big picture that says, this is what you're going to get paid, this is when you're going to get paid, and this is how you're going to get paid. And so it's not necessarily going to be a limit as to how you as the recipient or the investor can use those funds. That's not typically going to be what you're finding in this type of a trust arrangement. It's just going to be a matter of this is the when, where, and how you're going to get paid.
Gotcha. Thank you.
Yeah, I think the one thing I'd like to add to that is, even though you set up the installment agreement at the beginning to say all of those dynamics, you can always go back to the trustee and renegotiate and change it. You just can't tell the trustee to change it, right? You can renegotiate, and if he decides that, yes, we can certainly extend this 10 years or we can accelerate it, it's his decision, right? He's got control of the assets. The decision is his, but you can still negotiate something long-term and change the terms.
So it's part of the reason why we're kind of just hearing about this. I'm sure there's some people that might be wondering, I wish I had known about this. Is it because this is a trademarked name that it's kind of something that maybe people aren't familiar with?
I just
or
think
it's underutilized?
I just think it's been underutilized, that people just don't realize it's out there. People are familiar with 1031 exchanges and they hear that. This is just an alternative to that, because this one's not limited to a real estate swap. You can use this for any purpose. And it's just, for whatever reason, it's not received the same press that 1031 exchanges have, but it's been around for several years now. And there's been thousands of them set up. It's just one of those secrets that you kind of stumble upon, after they've been around for a while.
And
the other thing that I would like to point out is that, like Christina just said, it's for all classes. So 1031 exchanges are restricted primarily to real estate with the new tax law changes. So you have to sell real estate and you have to buy real estate. right? You've got to go 1-to-1 or 1-to-2. Where I sell a house, I can buy an apartment building, but it's real property to property, and that's where the restriction is. This is a lot more broad. I can sell my company assets, sell my company, take those proceeds and invest it in stock. I can invest it in real estate. I can invest it in bonds, whatever I want to do on that side. The trust can invest it and have it garner and generate more income long term. You can actually run it through the business and have the trust buy another business. So you just don't have control over it, but there's it's a little bit more flexible in the things you can do. And if you're stuck in a 1031 exchange and somehow that deal falls through, you can use this to effectuate the same type of tax savings that a 1031 exchange does. So if the timing runs out and you're like, I never found the replacement property, you can do this type of trust to kind of do the same thing.
Okay. And that's one of the benefits of this type of arrangement, using the deferred asset sales trust over kind of the installment sale, because you're not having the higher risk of the not being paid or something falling through with the installment sale. And then you have all these other options with having sale completed and in the trust.
Yeah, I mean, all of us know cash is king, right? Cash in the door carries a lot more weight. A contract is really only as good as the integrity of the person that wrote it. Not meaning the attorney, meaning the person who signed it, I should say. But reality is, I see it all the time. People do a business sale, they try and help out, they sell or finance, the person stops selling it. Now the business owner's got to try and collect his cash and spend 3-4 years in legal suits and might get a third, 33 cents on the dollar they might be able to collect. This way, hey, I've got the cash. Now I'm planning the future for taxes. So if tax rates go up, I mean, that's the other thing that wasn't factored into this, is capital gains tax rates right now, they're talking about really increasing them. Well, now, instead of me saving 20%, I'm saving 43% on capital tax gains rate. I'm going to spread that out. I'm going to spread it out as long as I can until somebody else gets in Congress and lowers those rates. And then we can accelerate those.
Awesome. Any final thoughts from anyone on our panel? Oh, we're good. Awesome. Well, thank you everyone for joining us. This was a lot of information. Thankfully, you can always catch the replay on YouTube and follow up with those questions in our Facebook group. That information is in the chat, as well as our contact information. Thank you for joining us. We have truly enjoyed bringing these 30-minute presentations and hope you have found value in them. We are excited to roll out our new formatting starting next week, and we will bring you true espresso shots of knowledge Monday through Thursday via our YouTube channel and Facebook. Our information, again, is in that chat box to connect with us, and we look forward to connecting with you soon. Have a great rest of your day.